our Friday webinar series, and I'm very happy to share. Ricardo, you Ricardo, we have done more than 300 webinars. That means you can
Wow.
imagine about 500 hours of discussion, and that also means about 600 to 800 experts coming and speaking to us, both on contemporary and domestic and global issues. And
I
since
think
you last
Ricardo's
came,
come earlier on this
yes,
platform.
he has come earlier.
It's the second time.
Yeah, this is his second visit. And during
At least.
after your last visit, we had this Trump tariffs come in. So we have had a series of lectures on Trump tariffs.
Of course.
And none from India. People shouldn't say we are biased. All the speakers were from abroad.
Okay.
So we have been following this up in a big way. I must share that Ricardo is a dear friend of mine. We were together. I was doing my postdoctorate at Harvard and he was doing his PhD with Professor Mankiw. And Ricardo has kept up the pace of research. Even at Harvard, I do not know, we used to call it the bunker, where all of us used to meet and bump into each other. Uh, he was the star PhD student, and he has kept pace with that. And this I'm talking of 2003, 2004. He's right now a professor at London School of Economics. But most importantly, he did his earlier studies at London School and then he followed it up with a PhD from Harvard. He taught at Princeton from 2004 to 2008 before moving on to Columbia and became a full-fledged professor at the age of 29, one of the youngest ever in the history of the university. If I'm not wrong, Ricardo, Mankiw also was very young when he became a professor at Harvard,
That's right. That's true. Yeah.
right?
Yeah, that's
So
right.
I would say able student of a able professor. Right. To chair this session, the topic, as you have seen, is a fantastic topic, will be also very interesting for all of us, financial repression. We have requested our advisor, Professor Ashima Goyal, to come and chair this session. As we all know, Professor Ashima Goyal was member of the RBI's Monetary Policy Committee. She has been member of the Prime Minister's Economic Advisory Council, and she has been a professor at IGIDR for a long time. She has been on top of these issues. She writes regularly, publishes regularly, and is in the midst of heart of public debate on such issues. So we invited Professor Ashima Goyal to chair this session. Over to you, Professor Goyal.
Thank you. Thank you, Charan. Great to see you again, Ricardo. I'm looking forward to listening to you. This is really a very, very important issue globally. The way debt has gone up across the world after the series of shocks. And normally when the interest payment share crosses about 3% of GDP, I think that's what happened in the Clinton time in the US, then governments start, fiscal consolidation. But this time, things are very different. There seems to be very few discretionary payments to cut continuing wars, populism, all sorts of things. So what is going to happen? But when we looked at the aggregate data, I found that most advanced economies, apart from the US, have reduced debt ratios from pandemic levels, and in emerging markets have increased. But India is an exception. They've come down somewhat here. So I think if debt levels continue to be so high, then either financial repression but the other interesting issue is that can US do a bank, or can the Fed do a Bank of Japan? In the sense, can they support government borrowing? Because under inflation targeting, you can keep absorbing the excess liquidity. And that's also a kind of financial repression. But are we going to, and then so we're looking forward to learning from you what the options are, what is likely to happen. And we'd like you to a little bit about emerging markets and their situation in all this.
Very good. Well, thank you so much. No, thank you so much for the invitation, Sharad, and thank you so much, Professor Goyal, for the great set of words to set the stage for what I'm going to be speaking about. So what I'm going to be talking to you is this lecture that I gave at the IMF annual meeting or the IMF conference research meeting just 2 weeks ago, and which is exactly on this financial repression topic. And so it has the same, the Mundell-Fleming lecture. And just to be clear, that's what I'm going to be delivering to you. And even in the last 2 weeks, I've changed some things in terms of how I would think about it now. Not many, but generally, I hope it will be a good setting for our discussion. Oh, just to confirm, so I'll speak for about 40, 45 minutes, and then we have 50 minutes of questions. That's right? Or a little less. How long should I speak for?
Yeah,
Be
you
sure.
can go. Yeah, 40 minutes is fine, or 45. Like that.
Okay. Very good. So the setting is precisely the one that I was already noted, and that is that government debt in the world is very high. Now, you may say, "Oh, aren't economists always worried about government debt being high?" Well, there's some truth to that, but this time it really is. And what do I mean by that? What I mean by that is that if you look at the raw numbers, government debt in the world, gross public debt, is around 95.1% of GDP, which is much higher than it was before the pandemic. During the pandemic, we borrowed a lot. We said we're going to pay it. And by 2023, the world as a whole said, forget about it. Let's start spending again and accumulating a lot of that pretty quickly. By 2030, given current fiscal plans, we'll be hitting essentially 100% of debt to GDP, which is pretty much where we were 2 years after World War II. So really the highest level of government debt that we had seen. And this not as a result, not of a pandemic, really, but rather as a steady pace or an increase. Moreover, note that obviously at the head of this is the US with a very large increase of almost 12, more than 12 basis points, but also emerging markets. Sometimes it flies under the radar that emerging markets have quite dramatically increased the amount of public borrowing over these 5 years. And they're expected to continue at a very, very fast pace, well above the world average and well above advanced economies, in spite of the influence of the US, which is great. Okay, so there's really a lot of public debt out there. The other side, though, and sometimes mentioned but in very different debates, is the fact that country debt, national debt across countries, what economists call the net international liabilities or sometimes the net foreign assets, have also grown a lot, especially in the last 20-ish, 10-ish years. And this increase, now, when it comes to the world level, on average, it has to be zero, because if there's a creditor, there's a debtor. But if you just look at these, I included here 9 economies, the G7 plus India and China. You have that even across those 9, the average is actually a little bit positive, but towards zero. But what you have is that you have one country that's borrowing a lot, the US, from the rest of the world, 700% of GDP. It's actually already increased to more than 80. France and the UK somewhat, and then Japan and Germany, and as well as China, especially in numbers, lending to the rest of the world. So we also have a lot of debt across countries. I'm going to call this the twin debt problem. Now, you may say, is this a problem? You may say, well, it's not. I mean, what's wrong with borrowing and lending? That's what capital markets are for. But what I will note is that as much as economists 30 years ago, and especially when the Mundell-Fleming model was starting to make its headway, used it to talk about twin deficits, that is, flows of both the current account deficit and the government budget deficit. Today, it is a stock problem. It's a twin debt as opposed to a twin deficit problem, whereby we have large amounts of debts. And what I put here is, as you go from 1983, you can start almost from the end of Bretton Woods and beginning of the current international market system, every 10 years up until 2023, and you look at each country of what's happened to their gross public debt and the net international liabilities, and you see this very clear movement over time to the right and a fanning out. That's a twin debt problem. We just have a lot more debt of the government to households and a lot more debt of some countries with respect to some other countries. And so I want to start with this, point at the twin debt problem, not twin deficits, but twin debts. It's really a stock problem. Moreover, and to be clear, even behind these countries that are positive on net in lending to each other, note that the gross liabilities are very, very large. The UK, being a financial center, has gross debt towards other countries of more than 5 times the GDP. Now, it has assets, claims over the countries that are another 500%, and so on net, it's only borrowing 24.9%. But this gross stock of debt, which includes to a much smaller extent India and China, but very much these other large economies, implies that there's a lot of debt just having to be repaid in general, even in gross terms. And as we learn from financial crisis, often it's the gross, not the net, that matters the most, because the gross is what's going to determine whether I want to pay you before I net out and pay others or not. Okay. In this context, where you have governments that have a lot of debt towards their citizens and as representatives of their country towards the rest of the world, it is very natural, I would say, that, and going back a little bit to Sharan's introduction, that you say, well, how do I pay both debts? Tax the foreigners. I can pay both my debt to the foreigners and my debt to the households because I collect the tax as the government. And lo and behold, what has been the reality of the last 6 months, which in part is inspired indeed by the twin debt problem, is let's put tariffs. Tariffs are nothing but a tax on the sellers of goods, those foreign sellers of goods. Okay. Now, what I put in your picture, though, is imports over GDP to get a sense, which sometimes is forgotten, that even in countries that are very active in international trade, like India, imports over GDP are around 20-ish, well, for India, 23% of GDP approximately. That means that even if you put some very large tariffs, best case scenario, you can generate maybe a 2% a year of revenue, let's say. Certainly a lot of discussion around how much the Trump tariffs will deliver. Certainly less than the US administration claims, but more than maybe would have been desirable. But it's extremely hard to see how in any well-defined economic model where imports will shrink in response to the tariffs, you would be able to extract more than 2, maybe 3% of GDP, and with massive distortions in terms of the world order. But from the perspective of the policymaker, there's an alternative. And the same policymakers that jumped on tariffs as a way to solve their twin debt problem are sooner or later, or I might even argue already, have started figuring out that there's a better way to do it than taxing the flow. Because if you have a stock problem, solve it by a tax on stocks. These are not the gross liabilities, just gross debt liabilities, opposed to gross total liabilities. And we're talking here about 80% of GDP on average. If the United States tomorrow said, instead of putting a tariff of 10% on the sellers of goods, I put a tax of 10% on my creditors, they could get 8% of GDP just like that. Okay. Now, is that a good policy? We'll discuss it. We'll spend the next 30 minutes or 45 minutes talking about it. But for now, note how tempting this is. If you owe a lot of money to someone else, cutting that stock, taxing away some of it, is just an extremely tempting way to solve your debt problems. Note, from the perspective of a government, and many of you, or certainly Professor Goyal, has been in government, it is a deep lesson in economics that we've learned through pain over many decades that it's always very tempting to talk stocks of wealth or property, but they also tend to be extremely distortionary taxes that raise very little revenue and they end up making countries much worse off. We don't expropriate people for the most part. We realize that expropriating is a very tempting way to solve any debt problem, but it's also not a very desirable or effective way. What I want to discuss in this lecture is exactly whether taxing the holders of the debt is a way to solve the twin debt problem. I'm going to call these financial repression policies. So to be clear, these are policies that lower the twin debts by transferring resources from the creditors, the holders of the external public debt, to the country. I'm going to exclude outright default. Obviously, the easiest way to transfer is to say, I'm not paying you back. But I'm going to exclude that one from being financial repression. I think that deserves the name of itself. We call it sovereign default. We have a whole literature about it. We understand some of it and understand the pains of it. Okay, so I'm not talking about that. Note also that financial repression has often in the past been used in a much broader way to discuss pretty much any government intervention that distorts the flow of credit, or in a much narrower way, just to refer to in some literature to governments forcing banks to buy government bonds. I have this, I think, better defined because more precise and broader in a sense, now another definition of financial repression, which is policies that fall on the creditors and that lower the amount of liabilities that the country has. Okay. To be clear, to remind you, for those who need a reminder, these were very common. During Bretton Woods, these were very common. What happened was in the 1970s, extremely influential work, and actually the term financial repression goes back to influential work by Shaw and McKinnon in the early 70s, that noted that a lot of these policies that had started, many of them post-World War, in order to relax the budget constraint of the governments that had a great deal of debt coming from the war, in the 70s, there was a perception that these were extremely distortionary. They were getting in the way of development. And the IMF and the World Bank, but especially the IMF, went around the world preaching how we should really get rid of this financial repression policies and we'd unleash growth. This was a big part of the so-called financial liberalization of the 70s and 80s, which had quite a bit of hiccups. But this is what's coming back now after basically 40 years where these policies were, not that they weren't there, but certainly on the background. And I want to study the extent to which they are coming back. What I want to do is assess really their current revenues, the potential for those revenues to be higher, and their trade-offs. Let me start with some theory, by which I mean just the concepts to understand what's going on. It is a matter of accounting that the change in the liabilities of any agent is equal to how much it had to pay out to the holders of those liabilities, to its creditors, minus the new net income that it has. This is accounting. This is the definition of how liabilities evolve over time. Economics is the following. Economics is the following optimal statement, if you want, meaning the same about behavior. My creditors will not lend to me unless they expect to be repaid. I have to promise a repayment in order for them to hold that debt. They have to, in their beliefs, in their expectations, believe that they're going to get their money back before they lend to me. Okay? Combine that accounting with that economics, and you end up with the following so-called intertemporal budget constraint of the government, or of any agent, actually. Debt, it follows simply from this behavioral assumption and this accounting identity, that the debt of any agent is the expected present value of its net income minus the change in the actual market value of the debt plus the expected value of discounts. What are the discounts? Imagine the government is able to, for a period of time, borrow from the creditors at a lower interest rate than the ultimate interest rate at which they're now willing to let me run a Ponzi scheme. That is what I'm going to call a discount here, a discounted debt return. Let me be more precise. For the public debt, that equation says that the public debt is equal to the expected present value of primary surpluses plus the market devaluation of liabilities. So if I have more surpluses, allows me more debt. If I'm able to lower the value of my liabilities, more debt. If I get more discounts, more debt. What is financial repression then in this context? First term is the conventional term. You raise more primary surpluses, you can pay for your debt. Financial repression in this context would be a tax on the financial sector or the creditors, a tax on banks, a tax on the creditors that says that given your flow of activities, flow, not stock, your flow of activities, you have to now pay me a tax. For instance, every time I pay you interest, I keep 10% in the case of a interest tax or withholding tax or corporate income tax. Second, market valuation liabilities. Again, famous version of this is sovereign default. I owe you the same amount of debt, but it's worth now a lot less. What is financial repression in this context? Financial repression in this context is unexpected inflation. If there's unexpected inflation, since public debt is denominated in units of my currency, will lower the real value of the debt that you have, that you hold over me. And so that will lower again the effective debt that I happen having. So financial repression is the extent to which I can have unexpected inflation that lowers my debt to you. This third term is often ignored, but it has, of course, for a monetary economist like myself, a very long tradition and is very familiar. Seigniorage from physical currency is exactly a discount. Currency is yet another public liability, and for some reason, people are willing to hold it even though it pays zero interest, while at the same time, to hold government bonds, they require 3%, 4%, or 5%. Why that discount? Well, because people like currency, it allows them to make payments. We've called this term from time immemorial seigniorage. That's what this discount is. But whenever a financial asset, and in particular the public debt, some form of public debt beyond currency, gives its holders some service, it's helpful for payments, as collateral or something, then those holders are willing to give the government a discount, and that present value of discounts is this term. What is repression in that context? Repression in that context is increasing the discount, which, since the government is the monopoly issuer of its own debt, obviously nobody can borrow in the name of the government, means making somehow the supply of that service scarcer. I will elaborate even more on this. But before it, to make sure that we're really on the same page conceptually, another version of this is for the country. Twin debts, public debt, external debt. The external debt is the expected present value of trade balances and transfers. This is the current account, the conventional term. What's the financial repression version of it? Tax the foreign creditors. Market evaluation of liabilities. These are sometimes called as valuation terms. What is the financial repression? Unexpected appreciation of the currency. Now, what the foreigners want is in terms of their currency. If there's an unexpected appreciation of my currency, this is a form for me to engage in financial repression, give the creditors less than that they were hoping for. And this third term, the discounts, in the international market literature, has been given a funny name, an interesting name. It's been called the exorbitant privilege. The fact that I'm able to borrow at a lower rate from other nations. It was given this funny name all the way back to Bretton Woods because that's what the US and the Bretton Woods systems had. Because it was the gold of the Bretton Woods system, everyone needed to hold it in order to pay their exchange rate. And in exchange for that, they would therefore charge the US less of an interest in holding its de facto public debt. And so it earned that name, the exorbitant privilege. But even today, insofar as the US provides insurance to the rest of the world, in what do I mean? Central Bank, the Reserve Bank of India and other places hold US treasuries because they think that in bad times, they're a safe store of value. Well, then the Reserve Bank of India and all of the investors in treasuries are willing to receive a little less in interest in exchange for that benefit, that insurance. Well, this is just like insurance premium and insurance payment. In bad times, the US treasuries are useful. In good times, they pay a little bit less than other equivalent liabilities. Okay? So to be clear and at the risk of belaboring, there are three classes of financial repression. The one that raises resources directly over the flow of finance, the one that raises resources unexpectedly by changing the value of the stock, and the one that raises the flow of resources proportional to the stock of debt in an expected manner. Okay? Now, let me give you a benchmark to understand why this is conceptually useful, while at the same time, these terms are obviously related. If I charge a tax on returns, like I said earlier, I say 10% of the returns you earn on holding my debt, I tax, well, that increases this first term. But insofar as that means that now you require a higher interest rate ex ante to lend to me, that's going to lower that second term. In the example where there's perfect efficient financial markets, the increase in the first term is exactly offset by the fall in the third term, and the effect is neutral. This is the classic case of efficient financial markets, where if you tax the movements of capital flows, you just pay a higher pre-tax interest rate, so the post-tax interest rate is the same, and as a result, you end up with no relaxation of the financial repression, okay? Likewise, a permanent increase in the value of the flow of the services can increase the third term, but insofar as it increases the value of the debt, it may actually increase the second term. And again, in an efficient financial market, repression will have an impact of zero. You cannot repress an efficient financial market where people completely anticipate everything and completely move with infinite elasticity of capital. But even if this is on average, when we measure in the data how large this has been, for instance, by measuring the return on US assets, this is what I put here, versus the return on liabilities of the US, or on the right, what has been the interest rate based on the debt, what you see is that over periods of decades, this is sometimes large and very much non-zero. That is, yellow can sometimes be above green, and therefore there being some of this payment. So what I will do for then the next 20 minutes, before I shut up, is go through these three terms. Having understood what financial repression is, where it comes in, is seeing how large are these terms today across the world in different countries, how large can they be? Let's start with taxing the first term, taxing the financial sector. Taxes over GDP in the US financial sector have averaged 0.1% of GDP, a tiny amount. And why? Because the whole value added financial sector has hovered around 7 to 8%. It's very hard for you to extract the tax from a sector that's especially elastic and that has such a low value added. Finance isn't that big, and I live in London. It's big here, but in most places in the world, it's just not even that big. Okay, so taxing this is going to generate 10, 20, maybe 30, maybe you can push this to 40 basis points of GDP, but not that much more as a flow. So if you don't tax the activity, what can you tax? Well, you could tax the flows. The best example of this is Brazil. Brazil, starting October 2009, put a transaction tax, a famous capital control tax, on any flow of equity or fixed income. What it found, of course, is that as soon as you put a tax on some form of capital flow, other capital flows come in that substitute for it. So it had to extend this to derivatives, raise its interest rate at 6%, but eventually found that chasing these returns was so hard that it had to repeal this tax. Now, there's been a literature on debating the effectiveness of this policy at managing capital flows, but note that its revenue from taxing was peaked at 2012. This is a tax on all financial transactions, and so it was 3.2% of GDP, 3.2% of tax revenues, which is approximately less than 1% of GDP. But the transaction tax, the flow tax, was even less than that. It was 0.1% of GDP. So you can tax the flow of capital, but as a source of revenue, not as a way to, in an integrated policy framework, avoid financial crisis, but as a source of pure revenue, as a form of financial repression. Brazil pushed it as hard as anyone has in the last 20 years, and they raised at the peak in 2012 was 0.14% of GDP, a relatively slow amount. What about taxing stocks? If you can't tax activity, you can't tax flows, let's tax stocks. Let me tell you about Ireland. In 2011, following the financial crisis, it put a large and politically extremely costly tax on pension funds assets. It said, look, I'm just going to tax some of your retirement money, okay? It kept it for a few years. I'll repeat again, as you can imagine, incredibly politically costly. You expropriated people's retirement savings. How much revenue did you raise? At the peak, 1.7% of total revenues, which again, once you scale it by GDP instead, 0.4% of GDP. So the first repression, activity, stocks, flows, even if you went for all three, and I picked the biggest examples that I could in relatively large advanced economies, set up the 3 points, 0.1, 0.2, 0.14, 0.25, 0.3, you get 0.5% of GDP from the first term. With, at the same time, massive distortions of the financial sector, going back to McKinnon, Shaw, misallocation of credit, very difficult to even collect anything given our financial innovation the Brazilians gave up within 2 or 3 years, and expropriatory policies that are, of course, highly unpopular, and rightly so in many ways. Second term, what about the unexpected term? Here I have a graph where what I did was I started with the World Economic Outlook's forecast for how the debt of India would evolve from 2019 to 2024. And then I went to the World Economic Outlook of 2024, saw the actual outcomes, and compared what the IMF thought would happen with what happened, so that I could break the increase in debt into how much was it due to this surprise increase in debt, how much was surprise increase in surpluses, surprise government growth, surprise interest rates, and surprise inflation. And note that we absolutely inflated away some of the debt. Italy did it the most extreme, almost not, a little bit above 9% of GDP of its debt was inflated because we had a lot of inflation between 2020 and 23. China had deflation relative to what was expected, and so they actually had revalued that. And so from here you say, aha, I got it. This second term financial repression, I can get 8% of GDP from doing this. True. But it's unexpected. Let me extend the exercise to 1971. And this is the big number, 2022, which is really the bulk of these 9%. And you see here, this was a 4% here, 2, and then there was another 4% in 2022 that I didn't include. Yes, this can be massive. But on average, over the last 50 years, this has been 0. Yes, you can inflate away the debt, but throughout the 80s and even 90s, you were reflating the debt. Bondholders, the creditors are actually doing better than you'd expect. Okay. So the question is, yes, you can do it once, but you can't do it systematically. And that just comes from the definition of it. It has to be unexpected. You can't do it on average for over 70 years. How much can we do it now? The size of the effect, and this is theory, depends on the composition of the debt. If it's indexed to inflation, you can't inflate it away. If it's very short term, you can't inflate it away because it basically has its price repriced once it rolls over every night, say. It depends on inflation dynamics. If it takes longer for the policy of financial repression to push up inflation than it takes for the debt to come due, then you can't really do it. And likewise, for even if you're able to raise inflation significantly, it can't be just for a month. It has to be during the duration of the debt to maximize the devaluation of the debt that you can do. And third, of course, it depends on it being a surprise. Okay, it depends on people's expectations being subdued, expectations moving slowly. Those are the three determinants of whether you can do this. Okay. In 2019, we were all surprised by the pandemic and then very surprised by the inflation that came after, or at least some of us, not all of us. Again, my last talk here at this 2 years ago or 3 years ago was me saying, I think there's a lot of inflation coming. So I wasn't completely surprised, but a lot of creditors, I sold all my bonds, but I think a lot of people were surprised. Second, we had inflation shooting up very quickly, persisting for 3 years and coming down. That's perfect because, for instance, in the US, the duration of the debt was approximately 3 years, 3 or 4 years. So the US almost maximized how much it could do. But what if you look right now? And so this is a topic that I've been working on a lot after 2021. And what I have found in the UK data is that now, even though expected inflation now is relatively under control at the 5-year horizon in financial markets, it is the case that in the last few years, any news about CPI now comes with an overreaction of those prices. So if inflation was to rise, I expect that these prices would actually move very quickly. Second, that if you look at also the survey expectations of people, and now let me shift to the US, what we've seen again is that short-run inflation shocks has made expectations much more jittery. In other words, these expectations don't seem slow to move at all. And finally, that if you look in the European area data and look at the cost of insuring against tail events at long horizons, that has decisively and persistently increased. In other words, the ability to surprise people now seems to be much smaller. If inflation jumped up to 5% tomorrow in the US, the UK, the euro area, I expect expectations would adjust almost very quickly, even overshoot, and so therefore your ability to inflate away the debt would actually be extremely low. Third and final term, the service flow. Let me explain a little bit of what that is. The service flow relies on there being some segmentation of markets, some barrier to arbitrage, you can't have efficient financial markets, and some service from holding the debt. As I told you, I'm going to call that a service, and I'm going to call the discount the difference between the interest paid on the debt minus the interest that debt pays relative to some benchmark, as well as potentially the change in value of it. Okay? Now, there's been a very exciting literature in the last 15 years in economics as finance has really moved to modeling inefficient financial markets of trying to estimate what these demands are. Demand-based asset pricing is one of its names. Measuring these discounts often goes in the name of measuring convenience yields. The service often is called specialness of the debt. But there's a gigantic amount of work in finance. I might even say asset pricing is probably the most active literature of the last 15 years, is basically measuring these downward sloping demands. Now, as you may expect, it is hard. It is very hard to measure these demands. But note, to measure financial repression, all I need is to know how much of the debt is held and the current value of the discount. Because the repression, the tax, is this amount. We would eliminate it if we followed Milton Friedman's old insight that since the government can issue its different types of debt from currency to bonds at zero cost, they're just pieces of paper, the optimal supply is to satiate all of the services that they provide. That's the blue point. It is by pushing the demand further out while keeping supply constrained that the government gets this inefficient financial repression. Another form of financial repression, of course, is to tax some of the producer surplus of some of the intermediaries, but the inefficient one is this one, the rectangle over here. So the insight is that as long as I can go over the government debt, and I will, all the different types of debt: domestic held, long-term, short-term, foreign held, central bank held bonds, currency reserves, and the central bank one. If I can go for each one of them, and for each one measure the return on it relative first to government bonds, and then for the last one, for the short-term government bonds, I'll measure relative to the benchmark, I will be able to then, by multiplying these by that, I will be able to measure how much financial repression there is. So let me go ahead and do that. Let me do it systematically, because one could do this. Each one of these bullet points we could spend a whole seminar on. Currency. What's the service? Anonymity. We like using pieces of paper that pay no interest because they allow me to make payments in an anonymous way, or store value in an anonymous way. What's the discount? It pays 0, even though I could deposit it at the central bank or a bank and earn interest rate there. Optimal would be the Friedman rule. But Friedman fought the limitation that he didn't know how to pay interest on currency. In a world where we have digital central bank money that could even be tokenized, script the anonymity, we could pay interest on that. And insofar as we pay interest, it is financial repression not to pay interest on central bank digital money. Digital money, meaning the one that banks enjoy by having deposited the central bank. The service they provide is liquidity for those banks. When they have a withdrawal, they can run down their reserves in the central bank and satisfy those. Because of that, they accept an interest on reserves that's lower than the interest on an overnight government bond. What's optimal? It would be to have what the Fed calls an abundant or ample reserve system. That is to have a large enough central bank balance sheet such that interest on reserves and interest on government bonds is roughly the same thing. Or similarly, from a financial repression perspective, you'd want to have a lending rate of the central bank close to the deposit rate, because why are you charging extra for liquidity? You're just making liquidity scarce. There may be good reasons, to be clear, moral hazard and others, to engage in financial repression. I'm not saying that you should always eliminate financial repression. All I'm trying is measure it and understand what is this optimal point I called this eliminating repression, which may indeed not be optimal given other considerations. Long-term bonds. What's the service? They give me a safe stream of income for a long time. I want to retire. I would like to have an asset that gives me safety for 20, 30 years of income. The government provides that through government bonds. Pension funds buy them and provide me that too. What is the discount? A spread between long and short, and between the very long and the 10-year spread. Okay. Optimal. The US in particular supplies too few long-term bonds. It should be supplying more because there's a lot of demand from an aging population to hold these long-term government bonds. Different countries supply, usually countries that have more aging have more long-term bonds because of that demand, but they should have even more given the demand for it. But moving next, and I'm getting further and further, for an international currency, the service is that people want to have dollar assets because they can match their imports in dollars to the assets they have in dollars. Many Indian companies who import intermediate inputs in dollars want to have some store of value in dollars so that they don't have exchange rate risk in terms of that store of value to pay for their imports. At the same time, many Indian companies have, or households even, hold dollars because the dollar appreciates in crisis and provides a form of insurance. That is the service it provides through its currency denomination. There's a way to measure this discount because both of this has to do with the denomination being in dollars. But the US government is not the only one who can issue denomination dollars. In fact, the Portuguese government issues bonds in dollars. The German government issues some bonds in dollars. I can compare the interest between those two, the relation between those two, and in doing so, figure out what is the benefit of issuing in dollars itself. This is sometimes known as a cross-currency basis, that comparison. Emergency lending. People want to have emergency lending from the US. This is why central banks have discount windows. Countries have swap lines. They're the equivalent of a discount window for foreigners. Domestic assets. Capital controls are nothing but stopping access to my capital stock. The discount is whatever tax is in those capital controls. For instance, in India, the ability to invest domestically requires changing offshore renminbi for onshore renminbi, and therefore the spread between those two exchange rates gives me the tax that I need to pay in order to get money internally. Perhaps more provocatively, exchange rate volatility, and I say provocatively because this was really Robert Mundel's Nobel lecture. I don't think he convinced most of us, but still, he said, look, exchange rate volatility in itself is a form of financial repression, because exchange rate volatility means that we need to deal with this risk. How would we eliminate it? By having an international currency. Everyone would use dollars. We'd have no exchange rate volatility. And by not doing so, governments are letting us bear this risk. Very final one is then the one between bonds and some benchmark. The key service here is the fact that bonds, US bonds, let's pick on the US, are very pledgeable. They are the ones that satisfy regulations of multiple types because they are the ones that are deep liquid markets. This is hard to measure, but there's both very narrow ways to do it. For instance, comparing the interest rate on a government bond with an interest rate on a supranational, like an investment bank, a European investment bank, say, or the Asian investment bank. Or why? Because they're in both ways assets that are almost identical in their safety, only that the difference being that one can be used for regulatory pledgeability of the other not. Or you can go very broad and say, well, let me just compare the return on the capital stock with the return on this asset. Either way, here are my three terms. Taxation, I told you, and let me show you how much we collected. I'm going to do this for the US because I can measure all these. 0.01% of GDP at most, hasn't increased much. Unexpected inflation, we did a lot of it, almost 2%. You may answer, wait, wasn't it 8? Yeah, but it's 8 divided by 4 years because now it's per year, so it's 2%. Okay? But as you go through each one of these discounts, what you realize is that the anonymity of currency went from 0.1, 0.2. So this became significantly large as interest rates went up. Liquidity, not a big deal. Duration, not a big deal. But importantly, already before and after the pandemic, we have a change where the benefit of the dollar issuing debt in dollars now actually means that you have to pay a premium. That didn't used to be the case. So this used to be a big part of flows, and actually now it's a drag on the US on the country. And likewise, there's been a fall in the extent to which there is a benefit of pledgeability from the US. So conclusions from this is pledgeability is the largest, but it's fallen a lot. There's been a big fall in revenues from dollar dominance. And actually, it's been the old-fashioned repression from currency and unexpected inflation. There were the key financial repressions that the US government did over the last 4 years. So it's a quantification of how much repression we have. How much larger can it be? Well, it turns out that depends on the elasticity of this demand. The more elastic this curve is, the more revenue in principle, the less revenue I'm able to collect. And reading through the literature, what I learned was that these elasticities tend to be very high, with the exception of the currency elasticity and some of the USD denomination. So the potential for a lot more revenue is actually very small because the elasticities are very, very large. Again, fast repression itself is not bad. In the same way that we may want to have some repression, the same way we have Pigouvian taxes. Some financial regulation is to correct market failures. But what I have shown you here is that as I work through exhaustively every single one of the terms, what I found is that they have not been very large. As we pushed on them in 2020-25, we got some money right away, but we also had that shrink immediately right after. And the elasticities lead me to predict that you will not be able to get a lot of revenues from financial repression. Let me conclude. Sorry, I'm running a little over, but let me conclude. Can I take 5 minutes more or discuss some cases? Yes. Okay. Thank you. So let me discuss to you, though, now, let me conclude as we talk about how can this be used. Let me tell you 5 examples of it being more used in terms of, so that you identify financial repression. Turkey, June 2022. Implemented the so-called Securities Maintenance Practice Program. What was that? Banks now were forced to hold long-term government bonds against the loans and deposits they had. This was supposedly, or the not supposedly, the aim of this policy was to stop what was seen as a dollarization of the economy. They call the realarization of the economy. What you learn from this lecture is that the way to measure financial repression is to measure the spread between the interest on Turkish bonds and the interest on bonds issued in Turkish lira, in this case by the European Investment Bank and a few other supranationals. Look how large the repression was, 40 percentage points. How much revenue was it able to collect? Much less, because it only applied to some bonds. And especially, it didn't last very long. You can engage in financial repression, but markets adjust, elasticities are high, give it a few months, and they close. Moving ahead, well, let me not move ahead. Let me, just in the interest of time. Second case, ECB, September 2023. The ECB used to pay interest on the reserves and then said required reserves, which it calls minimum reserves, from now on will pay no interest. This is financial repression. The banks are being paid less. They want to hold reserves because they need to hold liquid means, and they now have to get paid nothing against them. How much is this? 6 billion per year using the tools in this lecture. And the question is, should this be desirable or not, given other gains or not? Right now, there will be a budget in the UK announced next week. There's a lot of discussion about what tax will rise. But one thing that has been slid in through governments that started with the Conservative government last year and now the Labour government is proposals to say that in savings accounts, you have to invest them inside the UK, not abroad. This is financial repression. This is a way to increase the demand for UK government bonds, forcing me, resident of the UK, I now have to save in UK assets in order to get the tax discounts of my retirement account. This can be large money, but remember back to the Irish pension and the others, the elasticity of this is also very high. Raising the inflation target. Quite a few economists think maybe it's not such a bad idea for increasing the inflation target of 2 to 3%. That's fine. But note that there would be financial repression. And actually, this implies a benefit. That would be a 0.1%. We often discuss as if it was neutral. It's not neutral because there's currency, because there will be an unexpected adjustment, and because there's currency raising repression from it. Swap lines. The US government has swap lines with the rest of the world to which it provides liquidity. It also has, it started in 2020, having the so-called repo lines. The repo lines whereby the US, the Fed, would be willing to lend dollars to the RBI only and only if it delivers US treasuries as collateral. A very simple measure of repression, which I fear will happen soon from the Trump administration, is, and telling the Fed to just cancel all the swap lines and say, look, the repo facilities give you access to dollars all over the world. Nothing changes access to liquidity, but now you have to hold treasuries in order to be able to borrow from the Fed, whereas before the ECB and the Bank of Canada didn't have to hold treasuries at all. And finally, stable coins. Stable coins by themselves would, following the Mandela argument, reduce repression. Why? Because they're a digital form of payment. They allow someone in India to use dollars, potentially. That may be undesirable, though, and domestic regulations will stop you from doing so and will be another form of repression. Let me conclude, because I kind of went a little over and rushed throughout the end, and I want to leave at least 10 minutes for questions. What have I tried to do? I try to make 4 points. First, I start with an economic principle. The budget constraint that governs the nation serves as a wonderful discipline device for us as economists to think through a wide variety of policies. If nothing else, maybe I confuse you, but if I confuse you and nothing else, I show you the breadth of things that you can do with this concept in discussing, I mentioned at least 10 different policies from the simple narrow eye of how much revenue does it bring, how much financial repression is this, okay? My applied policy question is exactly, whenever we discuss any of these policies, stable coins, swap lines, paying interest on currency or not, we can discuss for a long time, and rightly so, whether this is a good or a bad policy. Is it efficient or not? Does it contribute to financial stability or not? But I said, let's focus on one simple thing. How much money does it bring? How much money? If you're in a government and you're the Minister of Finance, just ask, how much? Does this bring 0.2% GDP, 0.1? How much more would it bring if I did it 10 times more? Okay? I went through a lot of different policies, but again, the discipline of the exchange rate told me, think about each of the liabilities, think about the unexpected inflation, think about what you could tax, and put some numbers into those. I worry that this will come back in the 21st century. I know the temptation. And then I concluded that actually, as you work through all the terms, one, the elasticity of financial repression is the elasticity of the creditors towards financial repression is very large, and therefore your ability to raise significant amount of revenues is actually extremely limited, which leads me to worry a lot because it's very tempting. If you're a minister of finance all over the world, especially in the US, it'll be very tempting to apply these policies and see a chicken of golden eggs to tax there. And what I showed is that this will likely be highly disappointing because you will find that the revenue isn't that high, and then you'll have to deal with all of the welfare grants or not. In fact, I end up a little bit by studying this now for the last 5-6 years, this topic. I've been thinking about this, and this is the culmination of that. I end up recovering what I think is a lesson that we learned from the most classic form of financial repression, and that is inflation and its seniorage revenues it gives you. What we economists, I think, have learned through wonderful work, studies of history, is that whenever you say, let me raise inflation to 10%, suppress interest rates and print money, let inflation go to 10 or 20, it's the most tempting way to pay your bills in the government. Just print the money and pay the bills. It seems unlimited. If you're a treasury minister and you have one day to raise the money to pay the army, you print it. And we economists have learned over more than 100 years of thinking about this topic that it's also one of the greatest fallacies that any minister of finance will do. As soon as you start printing the money, the price goes up and then money is worth nothing. And you actually don't raise almost any revenue at all. In the meantime, you destroy your economy by printing money. What I found is that through a variety of financial repression policies, the same principle is true, that if anything, the seniors one was the least elastic, because when you could raise more. So if inflation was bad, all of these other ones are actually, if anything, worse in their ability to raise revenue. Let me stop here. I'll stop my slides and then.
Yeah, thank you, Ricardo. That was really a lot of food for thought. But, just to come back to the question that, and it's very interesting that you show that financial repression can't really raise much tax. Yeah. So now, if you are to talk of this question of rising debt and countries are not willing to tax their own citizens, and financial repression or taxing foreigners is not going to work, and also inflation. And I agree that only unexpected inflation works, especially today because of inflation targeting. There's very little tolerance for a sustained rise in it. Or even an unexpected, you need another pandemic or supply chain snarl to get in really high inflation. So, but the way inflation targeting works, like look at Japan. My original question of can the Fed do a Bank of Japan? So if you keep buying your own, the government's debt, but the US is an international open system, but still I think 80% of the debt is held internally.
Yep.
So can that that's also a form of repression, because what you do is you buy or you pay banks for the reserves they are holding of the extra liquidity created. So in that case, it's not floating around. But in India, we find that when liquidity floats around, it does create perverse incentives for the market. It's a kind of financial repression. So, do you see that as a possible solution for this large debt in advanced economies?
I don't.
You'll be able to absorb more debt without it being inflationary, without financial repression. Maybe it'll come down slowly, or it'll need some sort of disruption.
So I don't, and this is exactly so thank you for that question, because in some ways, in thinking through inflation, you touched on many of the points of the lecture, which was that it's tempting to say, maybe I could generate a little bit of inflation. You start with one. Can I even, whoops.
Yes, sir. Hi, sir.
Can I even, I was going to answer the question.
Please mute. We'll come to your questions just now.
Yes. So one is, can you do it? Which is your first question, which is, can I even generate the inflation? And I know that, look, you have to do it fast enough, and the maturity of the debt is already pretty low, and you have to take into account exactly the liquidity that you have in the economy. So the first one is that. It's like, can you even do it? Unclear. the best I think we can do, thinking about towards the Fed, is be negligent, meaning don't bring inflation as much down. And we're seeing inflation stuck at 3% in the US. I would say that that's a form of financial repression as far as we haven't gone to 2, but agents are catching up to it. And so you're not, and next, if inflation happened to jump up, again, be a little negligent in terms of how quickly you want to raise interest rates or bring it down. Those are the forms of financial repression. The question is, one, how much revenue would that raise? And once I started thinking about how hard it would be to engineer that, one. Two, as you noted, how the bank liquidity, that would translate into interest rates relatively quickly, given our expectations are. And three, how that would undermine some of the service discount that you get on bonds to start with. And we're already seeing what's happened to 10-year treasuries over the last 2 years. You add that all up, Professor Goyal, and you end up with, even if you can do it, it doesn't raise all that much money. The fear that, and on top of it, like you noted, which I didn't touch here in the stock, because that was the insight that allowed me to focus this. And this, of course, comes with a lot of welfare distortions and loss in the financial system, which I didn't even talk about. I just thought, how much money can you even raise? My fear, though, and as you noted, is that we go down that path. It's very tempting for Donald Trump, to say, what's wrong with having an inflation target of 3%? A bunch of economists say that's a good idea. Number two, let's keep interest rates low. If inflation runs a little bit at 3.5, 4, not a big deal for a little while of time. And then realizes that these actions made very little difference for the Treasury. Brought in 0.3, 0.4% of GDP and already down to 0. And the addition is, well, if 3 was okay, what's wrong with 6? And if a surprise of inflation being 5 instead of 3, what's wrong with 12? And that is exactly the story of 1980s Latin America and the hyperinflation, where it was the seniors and this fiscal pressure that kept on coming in. So that is, by laying it out, I'm trying to warn that it's not just on the inflation, but all the other forms of repression, from discount windows, from regulation to forced bonds and so on, they all have the same flavor. That is the key economic principle. And so when you say, Ricardo, how are we going to pay for the debt? I don't know. But what I want to warn policymakers is, don't think that you can pay for it through repression and be so tempted to buy it, because it will actually be very hard to pay for it that way.
Yeah, there was another very interesting sort of point you made with the Nobel lecture, and is that, exchange rate volatility is a kind of repression.
Yeah,
because in India, over the last couple of years, we've been experimenting with reducing the volatility of the exchange rate as it was really going up. The dollar was volatile, and we found that risk premium fell. So it's a kind of a subsidy that we were paying for. It's a higher risk premium that you have to pay in emerging markets.
Exactly.
Yeah,
Yes.
and then the reserves that we keep in order to be able to do this are invested in US treasuries. That is the least elastic, so it's the most liable to financial repression,
exactly.
taxation. But because of the sanctions and etc., unreliable, most central banks are moving more towards gold, other currencies. So that is also becoming elastic. So then these EM investments in advanced countries are becoming more elastic and less amenable to financial repression. So I think you could add that you would get very little from
it. Could be, yes, exactly. I've done the sin as an economist of measuring elasticities in the past data, discussing policies, using those elasticities. And that is a sin, because it is the classic Lucas critique scene that those elasticities themselves we'd expect to increase. But note, why did I do this with my eyes open? Because even with the elasticities that I used, which are biased downward by ignoring that response, I got small numbers. If we think elasticities are going to rise, I would get even smaller numbers, and my point would be even stronger. On the reserves, I think that's a very important point, by the way, and one that, in speaking to policymakers in the region very recently, and I hope to do a lot more in the next few months, I worry that policymakers in South and Southeast Asia are a little bit, policymakers, reserve managers, are a little bit asleep on the wheel. I'm surprised at how there is not more of a discussion in the area about how to rethink the reserves that should be held, quantity, composition, what are the risks for? The reserves, as you know extremely well, were built in many ways in the region after the 97-98 Asian financial crisis. It made sense to hold a lot of dollars as reserves, because that was a way to both intervene in exchange rates to smooth them, like you mentioned, as well as to stop sudden stops of investment for abroad, which had to be denominated in dollars. And it made a lot of sense why countries accumulated such large reserves in the 2000s.
Mm.
Active literature on whether they did too much, too little, but it was sensible and it followed good economic principles. But today, I'm surprised, Professor Goyal, how, if you think about the risks that India faces in terms of the central bank of international financial crisis, you would think that they're very different from those. It's not a sudden stop of dollars, it's rather some US policy.
Mhm.
It is potentially the fact that the US engaged financial repression and tries to expropriate you of your treasuries. It is the fear that China instead, if you move your reserves, how would you invest them? How would they allow you to invest them or not? The configuration of dangers from the perspective of uh, why you want FX reserves has changed. Given that has changed, I am surprised that there isn't more work, more analysis, more discussion, and then more actions in re-optimizing the reserves of the RBI, either in quantity, and I say this very earnestly. I'm not sure if you should have more reserves or fewer reserves today. If you should have how biased it should be towards dollars versus renminbi versus euros versus gold that you noted. And I think even the adjustment you mentioned, I think it's was more instinctive rather than well thought through. And I would urge people to think more about this topic.
Yeah, well, I really hope your warning is taken seriously by policymakers. In the sense, somebody like President Trump, you don't know, he's so erratic. He just might, because
Well, and
as you were
everything is a
saying, in
bargaining
the long
table.
term, it has zero impact or zero revenue.
Yeah.
But in the short term, it can create something. It gets so that temptation is there in short political cycles. So I think emerging markets have to be more defensive and to think through how they need to protect themselves. Yeah. And now we just, a lot of the comments in the chat pod, they're asking for your slides, if you could share
Yes,
them.
yes. I'll email them right away as soon as we hang up. Sorry.
Yeah, yeah. And Charan, would you like to ask some questions and we can open it to the
Ricardo, as always, so impressed with your presentation and the way you
Well, thank
think
you.
through things. Very impressed. This is exactly what I saw you in 2003. So happy you've retained that zeal
Yeah.
and you go like straight like a worm into the earth. Fantastic. You know that in India, our international reserves, we only made a policy after 1991. Until then, we were following the global pattern, 3 months of import cover at the maximum. But when we had a major BOP crisis, we said at least 1 year of import cover. And one of our deputy
Exactly.
governors, Tarapur, went into the depth of it. And then we started maintaining 17 months of import cover. For a long time, these politicians, sorry to say that, quote unquote, these politicians sometimes so get enamored, and sometimes the bureaucrats who work with these politicians sort of, I say, badly teach them or guide them, or and then say these reserves are too many, can we misuse them? They don't say misuse, but they say we could use it
You,
elsewhere,
sure.
which as a central bank, is misuse of the reserves, right? So it's a very dangerous, very I would say, area where you can skid a lot. But what I like in your presentation, and so we maintained 1 year of import cover. Professor Goyal has been at the MPC for a long time. She was also at IGIDR and she's been contributing to policy making in monetary areas in our country in a big way. So reserves have served us in a very big way. Other than what
Mhm.
you mentioned, helps us as a shield against the rating agencies. You mentioned
Yes,
about the swaps. Swaps also help us against the rating agencies, vulture
exactly.
rating agencies, which are there. I really do not know who heads them and who are the economists working there, but they come out with the craziest of benchmarks and penalize emerging countries, especially. Advanced countries, they can't touch because that's where they live. So our reserves help us in a way, safeguarding us from how the rating agencies look at us, and and you also know that some countries like India didn't go for the sovereign wealth funds for a very long time, and even now have not gone because we are not sure. Moment you give them little leeway,
Sure.
who's going to run away with what? We don't know. So the actually the central banks guards the reserves like a cobra on a heap of gold, right? That's how I would say. Now, I want to mention one thing, and I really want to appreciate that fact. After Harvard, I went to Stanford and worked with Ron McKinnon. And Ron
Hmm.
McKinnon was a pioneer in financial repression. And we
Hmm.
used to, in India at that time, still have financial repression the traditional way. You brought a very
Yes.
modern view on it, the
Yeah,
traditional
absolutely.
way. And Ron McKinnon and I used to always talk about what can happen. We never thought a day would come that we would be thinking of financial repression the way you have thought through.
Perfect.
And
Absolutely. That was the
that's why
goal.
I'm so happy, so happy. I actually heard your Mundell Fleming lecture, which you delivered at the IMF.
Mhm.
And I was very thrilled because Madam was chairing your lecture, and and the whole team that was sitting there. Now, the way you work through it, I think, is a great lesson for the policymakers as well as the IMF to tailor your suggestions and go country to country and say, this is not the way. This temptation has to be avoided. Firstly, it will not lead you in the right way. It hardly gives you any revenues. And Ricardo, what I see, if you can, and with the type of resources you have and the position you're holding at LSE, you have the best of both the worlds. India was a subject of London for a very long time, and America is not looking at you the fact that he called you for the Mundell Fleming. The markets that are going to get distorted from this adventurism is going to take the long time for them to recover.
Hmm.
Exactly the point which Ron McKinnon used to make with
That's the
me,
McKinnon. Yeah,
that
exactly.
that you could distort the market so badly for such a short-term gain, you would have done a very long-term damage to the market. And the trust that you would have displaced or the trust that you would have hurt will take a generation to recover. So I think a logical advancement of your research would be the distortion of the markets that would emerge from this adventurous, if you think appropriate.
Absolutely.
That's the only limited point I wanted to make, Professor. Thank you for giving me the time, knowing that we are under a time constraint.
Yeah, Rika, do you have some time or
Yes,
you
yes, yes.
have
I
to
can sit
leave?
till 1:15 or another 7 minutes. Yeah.
Okay. So are there any questions from the floor? Anybody has a question? Please raise your hand. I don't see any questions on the chat. They all are just asking for your slides. They're so impressed with
I'll email
this.
them right now.
Yeah.
So any questions?
You could raise your hand. You could come and speak the question on the, yeah, anybody. I don't know if Dr. Vinod Kumar wants to ask because he's been coming again, and then Dr. S. Vetanandine, if I'm pronouncing your name correctly. Any one of you
So,
wants to
so
ask?
if there
Yeah.
isn't a, yeah, there is a question. I was going to ask something. Yeah, Dr. Vetinandine, please unmute yourself and ask your question.
Nothing, madam. Good. Sir and madam has cleared all the point of view. What are the statutory levies has to be upcoming? Madam? I understand, madam. I got it. Thank you,
Okay,
sir.
okay,
Thank you, madam.
okay, very good, very good. Yeah, so my question, Ricardo, really I want to push this a little more, is that since financial repression is not going to work, and you are in inflation targeting regimes where
Yeah.
you can create excess liquidity and
Yeah.
absorb it by paying banks for reserves that they keep
Yes.
with you, or just buying government securities like the Bank of Japan does. Do you think that the debt, it need not sort of blow up globally? It can sort of or is there a temptation to create too much debt which has risks? Or is it or will it, so what is the path you see? Will it kind of because US is a very different country, it's the international financial center,
Yeah.
but still a lot of the I mean,
Of course.
originally there was that talk about safe assets being absorbed by China and China holding US reserves, but now you see after the pandemic how much extra safe assets were created. I mean, the central bank was holding so much of the government's, the quantitative easing and so on. So they can, what is the limit on quantitative easing?
Very. So let me answer that in three parts. So the first one is on the path ahead, including for other countries, and I mentioned already the management of reserves, I think is a very, very important one, and echoing also what both of you said. I think for the countries, the important thing to understand is that once you realize that financial repression is not the easiest, you do face the this time is different, in the words of my dear friends Carmen Reinhardt and Ken Rogoff, that ultimately you either fix your public finances or you face default. Unlike the US, you won't. That will default in other ways. You're gonna suffer through the humiliation and the humiliation in the sense of actual pain of a sovereign default, or you have to start making some hard choices. I think there has been there was an accumulation of debt over the last 20 years and an avoiding of responsibility that is coming to hit. And I worry again, the financial repression is the what hyperinflation was in the 80s is the financial repression of the next 10 years. And so the lesson is you just have to start fixing your public finances. It is noticeable, by the way, that for instance, if you look within the euro area, the two countries running fairly large surpluses in their budgets are Portugal and Greece. Spain a little bit. So
yes, Greece has done a fantastic job.
they're doing it because they understand that ultimately, sooner or later, you really have to fix things. And I think many countries are not doing that. That's on the other countries. Secondly, second part of the question is the US. And the US is, of course, the one what one worries, because I do worry that their default is difficult to imagine. We certainly, and in many ways, it's much easier for them to engage in financial repression than it is to do default. Much easier because going back to my elasticities, the elasticity of money in India is definitely much more elastic. I'll just take my money out in a way that there's less, as people like to say, there's less alternatives to the dollar, to the treasury, and so on.
Right.
Therefore, I think the US will engage in financial repression. And I think the consequences of that failure with dire consequences for welfare that Jaran was saying, are that this would contribute more to the fragmentation, deglobalization that policies are pushing for. Because of course, as they embark in that, what are those elasticities? Is me bringing my money back into my country. And a retrenchment in international capital flows will be that. Those I worry a lot about in the concept of Mandela lecture, because those flows have to come with large exchange rate movements. And so if I am to say, if a crisis is coming sourced in the US, what I worry is about the exchange adjustments. And let me tell you why already concretely as we speak. The tariffs of the US, what they're implying is large exchange rate adjustments between the euro area, China, and the US that have been very difficult in the last few months. You just have the whole configuration of trade between these three very large blocks has changed dramatically and put enormous challenges for the Eurozone, just to mention one. So that's my second thing, which is, I think other countries, if other countries are default, that was my first point. My second point is in the US will be financial repression. And the response to financial repression, if it's sustained, ends up being financial autarky at the limit and just a closing of blocks into blocks again, which is not a desirable world when it comes to capital flows. And then third, you mentioned the role of QE. So QE is a delicate subject insofar as people will disagree. In the context of my lecture, QE by itself is not financial repression. QE is not financial repression because it's just exchanging one government liability, government debt, for another one, reserves. Insofar as both of them, you have to really assess what is the relative repression of one versus the other to say whether there's any effective shift in the total burden of repression. But it's not obvious at all that it would. Some of my colleagues think that QE itself is a form of repression in terms of keeping down interest rates persistently. We have 10 years of research looking into this topic. Very little evidence that QE had a sustained impact in lowering interest rates on long-term government debt. Yes, a short-run impact. Yes, it helped, maybe for a few weeks, certainly for a few months, to control inflation when inflation was too low, but the evidence that it has had a significant persistent impact on the long-term bonds, which is what you would need for it to be a significant financial repression, is far from obvious. And then even if it has, you'd have to trade the financial repression against the on long-term bonds with the removal of repression on the short end that came with the ample and abundant reserves of the Fed. In an ideal world, the optimal ideal world I discuss, the Fed would have a large balance sheet, so it has ample abundant reserves, backed entirely by short-term treasury bills, and then there would be no financial repression at all. Once it started buying long-term bonds, we need to quantify it. My reading of the estimates and the literature is that there wasn't a lot of financial repression involved in QE, very little at all.
Then you are seeing rates going up, so but not as much as they
Yes,
were.
but I
say,
think that's because the result of the inflation we had and the fear of repression coming, which is eliminating the safe harbor nature of treasuries. Again, I don't think QE is a big part, or the stopping of QE or QT are any significant part of that. Very good.
So, yeah, thank you. That was
Oh.
really, really wonderful.
No,
Yeah.
thank you so much.
Thank
This was
you.
wonderful, and thank you again for the invitation and to discuss ideas. I do think they are important for policy in the next few years. I don't think more than the originality of the issue. So I think Karen really put it well, which was, I think we understood the welfare distortion costs of repression, but I worry that we'll be seduced by the revenue benefits of it.
Right.
And so I thought
The
it was
short-term
important
revenue
so that the revenue benefit, the short-term benefits, and that they are
Mm.
not really all that large. Thank you then.
Ricardo, you know that you're well known even for your research on central banking, and you have that wonderful paper on central banking.
Yes,
Now,
that's right.
I've been trying to get you for that, and you deflected me with this, right?
That's right. That's right. I thought this was important, and this is the one that I think
This
will
is
make a little bit more of a
fantastic. This
difference.
is
The other one
yeah,
was more
yeah.
interesting for research, but I think this is more important for the
Yeah, yeah.
world right now in policy.
Yeah, yeah, but this paper is extending the frontier of knowledge. Means I totally agree with you. This has really extended the frontier of knowledge. Fantastic. Now, my only question is, at your convenience, I would like you to come in and speak to us on central banking. As you have seen, there were some
Yes.
questions for you asking, is India's central bank really
Ah,
independent?
oh, I didn't see this.
Now,
Okay.
because you think and you devise policies and you're on so many institutions already, and for many central banks you're advising, it'll be a great idea. And you decide the time and you decide a convenient day, Friday. We would like to hear from you about central bank.
Sure. Let's talk about it in a few months.
So,
Mhm.
yeah,
So-
absolutely. I'll
Very
remind
good.
you in a few months.
So he's forcing you
Absolutely.
to commit in public, so you can't.
Absolutely. Oh, I'm happy to do it. Thank you very much.
Thank you very much. And
Have a
I
lovely
must
day.
say
Thank
the
you.
recording of
Yeah.
today's lecture will be available by noon tomorrow on our website. And we'll put it on, of course, Twitter also. Next Friday, we will most probably have a discussion on Indo-Russia economic relations because the president of USSR, Russia, is visiting us in 2 weeks. So next week we are bringing in that Indo-Russia economic relations. We'll let you know the time and the list of speakers sometimes early next week. So have a great weekend. Looking forward to your participation next Friday. And once again, thank you, Ricardo, and thank you, Professor Goyal, for spending the Friday evening with us. Thank you.
Thank you, sir.
Thank you.
Okay.
Bye. See you.